All right, today we are diving into one of the biggest, most fascinating questions in the entire world of finance. It's a real-life case study about a legendary company, an unbelievable mountain of cash, and a huge decision that's going to shape its future.
So, to really get into this, I want you to step into the hot seat for a second. Imagine you've just taken the top job at one of the most respected companies on the planet. A true legend's legacy is now in your hands. And on day one, you're looking at a choice that could define everything. And it all revolves around an almost unimaginable amount of money.
And this is the number at the center of it all. $382 billion. Now, to be clear, that's not the company's total value. Nope. That's just the cash and short-term investments they have sitting on the sidelines. It is the single largest corporate cash pile in the world. And right now, it's pretty much just sitting there.
So you have to be wondering, how on earth does a company build up a pile of cash that's bigger than the entire economy of some countries? Well, to get that, you have to understand the core philosophy that built this empire in the first place, what's known as the Berkshire Way. It's a strategy that has gone against the grain for more than 50 years.
This right here, this single idea, is the engine that powered Berkshire Hathaway. For decades, the argument was super simple. Instead of giving you, the shareholder, $1 back as a dividend, the company made a promise. They said, let us keep that dollar and we'll turn it into more than $1 of value by smartly reinvesting it. And you know what? It's a promise they've kept. They haven't paid a dividend since 1967.
So, the big question, did it work? Oh yeah, it worked. The results are just staggering. While basically every other big company in the S&P 500 gave cash back to shareholders through dividends, Berkshire kept every penny. The result? A mind-blowing 19.8% average annual growth. That's almost double the S&P 500 over that same long period. That, my friends, is the magic of compounding in its purest form.
But here's the twist. The very strategy that built this incredible success story is now the source of its biggest headache. It's created what people call a good problem to have, but believe me, it is still a problem. It's the dilemma of having way too much cash.
So why is having the world's biggest cash pile a bad thing? Let's break it down. That $382 billion is mostly just parked in stuff like short-term T-bills, earning about 4%. Okay, not bad, but with inflation humming along at 3%, the real return, what you're actually gaining, is almost zero. It's like a giant savings account that's just barely treading water. And maybe more importantly, those elephant-sized acquisitions that Buffett was famous for, these massive game-changing deals, they're just not out there right now. Everything is too expensive.
Okay, so if they can't buy other companies, what about buying back their own stock? That's another classic move. But that's getting a lot harder to do too. As you can see, their share buybacks have slowed way down. Why? Well, because their own stock price is so high, it's just not as good a deal anymore to buy it back.
So all of this brings the company to this really critical moment. The old playbook, the one that worked for 50 years, just isn't working like it used to. They are truly at a crossroads with two very different paths they could take.
Okay, here are the two big options on the table. Path number one, finally start paying a dividend. The pros? It gets that idle cash working and makes a lot of shareholders happy. But the cons are big. It's not tax efficient at all, and even worse, it could send a signal to the market that Berkshire's best growth days are behind it. Then there's path number two, stay the course. Keep doing what they've always done. This keeps that massive war chest full, ready for that next elephant deal whenever it appears. The risk there? A huge opportunity cost. Hundreds of billions of dollars just sitting there, earning next to nothing, year after year.
And that brings us right back to where we started. Back to you, sitting in the corner office with the weight of this massive decision squarely on your shoulders.
The torch at Berkshire has been passed from Warren Buffett to his chosen successor, Greg Abel. And for our purposes today, that's you. This isn't just a classroom exercise anymore. The market, your board, millions of investors, they are all waiting for your call.
So what's it going to be? Do you protect the 60-year-old tradition that built this entire empire, that magic of reinvesting and compounding? Or do you admit that the world has changed, bow to the pressure of today, and fundamentally alter the Berkshire way forever?
This really is the ultimate test of business strategy. You're weighing a legacy of patience and long-term value against the very real demand for immediate returns. It's a decision that's being whispered about in boardrooms all over the world. So what would you do with $382 billion?
There really is no easy answer here. And that's exactly what makes it such a fascinating puzzle. We really want to hear what you think. Lay out your plan. What's your move? Decide in the comments below.